Meta's stock is up 25% in 3 weeks. Wall Street's average price target is $846, but every single insider trade in April was a sale, not one buy, zero. And yesterday, China killed Meta's $2 billion AI deal. Something is off here. We pulled the SEC filings, the Beijing ruling, and the analyst calls. Here's what we found before April 29. April 29 is the day Meta reports first quarter after the bell, and right now the bull case and the bear case are both screaming at the same volume at the same time. We mapped 5 places where the signals point in opposite directions. Each one matters for how the stock moves on Thursday. By the end, you'll know exactly what to watch on the call. Let's start with the loudest contradiction. Meta is about to spend $135 billion on AI infrastructure this year. That's almost double what they spent in 2025. It's the most aggressive Capex number in big tech, period. Now here's the part nobody is connecting. Last week, Meta announced 8,000 layoffs. Reuters reports the first wave hits May 20th. So Meta is firing 8,000 employees to fund the same AI bet they're calling the future of the company. Both moves came from the same CFO, Susan Li, in the same earnings cycle. Both moves are real. But yesterday, the picture got worse. China's NDRC blocked Meta's $2 billion acquisition of Manus, the agentic AI startup Meta announced buying in December. Manus is the AI Meta planned to fold into WhatsApp, Instagram, and Meta AI itself. The deal had $100 million in annual recurring revenue at the time of announcement. Now Beijing has ordered both sides to unwind it. So Meta is doubling Capex, cutting 8,000 jobs, and just lost the agentic AI piece that justified part of the spend. The question Wall Street wants answered on April 29 is simple. Are the layoffs the start of cost discipline that protects margins, or are they a signal the AI math is breaking? Operating margin already dropped from 48% to 41% in fourth quarter. Barclays modeled a 90% free cash flow drop scenario. That's not a typo. So when Susan Li takes the call on Thursday, listen for one phrase: operating income above 2025. That's the line that holds the bull case together. If she walks it back, the math breaks. Stanley Druckenmiller dumped his entire Meta position in fourth quarter 2025. Every share, 76,100 shares, gone. He filed with the SEC on February 17th. He didn't trim, he didn't rotate. He exited, and he wasn't alone. Druckenmiller closed 30 positions that quarter. Meta was one of them. He moved the money into Goldman Sachs and a basket of other names. Now look at the other side of the same data. 67 sell-side analysts cover Meta. Their average price target is $846. From today's price, that's roughly 25% upside. Evercore reiterated buy at $900 last week. Deutsche Bank held $920. Both flagged first quarter ad spend growth at 6%, ahead of their own model. So one of the smartest macro investors of the last 30 years sold every share. And the consensus of 67 analysts says the stock goes up 25%. They're looking at the same company. They cannot both be right. Here's the catch. Druckenmiller sold in fourth quarter 2025. Meta dropped to $525 in March, then ripped back to $675. From his exit price, the stock is roughly flat, not down. So even the bear case has a clock on it. The April 29 call is when this gets resolved. Fourth quarter revenue grew 24% year over year. That's $59.9 billion in a single quarter. It beat consensus by $1.5 billion. The growth is not slowing. It accelerated from 22% in third quarter. Now here's the other side. In the same quarter, total expenses jumped 40%. Operating margin dropped from 48% to 41%. Reality Labs alone lost $6 billion in fourth quarter. The full-year Reality Labs loss hit $19.2 billion. So you have two things happening at once. Revenue is growing faster than anyone expected, and costs are growing even faster. First quarter guidance is $53.5 billion to $56.5 billion. The midpoint implies 30% revenue growth. If that lands, it's the fastest growth Meta has posted since second quarter 21. But guidance also flagged 2026 total expenses of $162 billion to $169 billion. That's a 38% jump from 2025. So the first quarter number to watch is not just the revenue beat, it's the operating income line. If revenue beats by $2 billion, but operating income comes in flat or down, the stock fades the print. That's the math the chart can't hide. Last November, Meta won the biggest regulatory fight of the decade. Federal Judge James Boasberg ruled the FTC failed to prove Meta holds a monopoly. The forced divestiture scenario for Instagram and WhatsApp is essentially dead. That's a multi-year tail risk removed. 5 months later, on March 24th, a New Mexico jury hit Meta with $375 million in civil penalties for child exploitation failures. The next day, a California jury ordered Meta and Google to pay $6 million for addictive platform design. Both verdicts were firsts. Both opened the door for thousands of similar lawsuits. Wall Street called this a possible big tobacco moment. So one regulatory threat just collapsed. A different one just woke up. The dollar amounts are tiny against $1.71 trillion market cap. But these are bellwether cases. The pattern matters more than the penalty. April 29 won't resolve this. The legal cycle runs on its own clock. But Meta's commentary on Section 230 risk and youth safety policy changes will signal whether management sees this getting bigger or staying contained. Here's the contradiction that sits underneath everything. The smart money calls were made in fourth quarter 2025. Druckenmiller sold, JP Morgan trimmed almost 20%. Fidelity cut. They filed in February. Then Meta dropped to $525 in March. Then it ripped back to $675 by late April, roughly 25% in 3 weeks. The trigger was easing Middle East tensions and the launch of Muse Spark, Meta's new AI model led by Alexander Wang. So the smart money sold, then the stock recovered. But here's the wrinkle. The Manus block from Beijing landed yesterday. The recovery happened before that news. April 29 is the first time management speaks publicly with both pieces on the table. Either the recovery is a relief rally that fades when Capex reality and the Manus loss hit the model, or Meta's AI execution outside Manus is genuinely changing the curve. Susan Lee and Mark Zuckerberg either confirm the recovery or break it. There is no third path. 5 contradictions, 1 earnings call, Capex versus layoffs versus a blocked Manus deal, Druckenmiller versus consensus, revenue acceleration versus margin compression, FTC win versus youth safety verdicts, smart money exits versus a 25% recovery. Every one of these gets pressure tested on April 29th. The bull case needs 3 things. Operating income guidance held, first quarter revenue at the top of the $56.5 billion range, and Reality Labs loss flat or down. The bear case needs 1. Any softening on the operating income commitment, or any sign that losing Manus changes the AI roadmap. That's the asymmetry. The bull case has to win on 3 fronts. The bear case wins on 1 slip. On the call, listen for 4 sentences. First, Susan Lee's wording on 2026 operating income. Any hedge there moves the stock. Second, the Capex split between AI and Reality Labs. The market wants AI dominant. Third, Mark Zuckerberg's commentary on Muse Spark monetization. Vague answers signal the AI bet is still pre-revenue. Fourth, any direct comment on the Manus block. Silence on Manus is a tell. Direct framing means management has a backup plan ready. Meta enters April 29 with no clear winner. The stock chart says one thing, the insider filings say another. The analysts disagree with the smart money. The regulators disagree with each other. Beijing just blocked the AI deal. None of these contradictions resolve until management talks. That's the setup. Now you know what to track when the call goes live. If this breakdown helped, hit subscribe. We're just getting started on this earnings cycle. There's a lot more coming.